think on the big auctions, certainly there are new names coming through. I don't know whether we should believe the rumours, but when Lloyd sold Chamonix in Germany, I think Marathon, that's reported numbers, I don't have any particular insight, but they were, 50 million euros ahead of the others. So I think that's a benefit of competition from a vendor's perspective. That's
40,
right. So that's out of 350 was kind of total consideration there. So it's quite, in percentage term, it's quite a big chunk. So there's no doubt competition is working wonders for the vendors. I don't know to what extent this is affecting pricing, but I do think the level of interest in some of the large auctions from some of the bigger names in the market, they're a bit tired of it. This is incredibly expensive. The Lloyd's type auctions work great for the vendors, don't get me wrong, but they are incredibly expensive if you lose. And I think you can see now the shape of the phase 2 bidders is not exactly the same as they were a year ago. And that tells you a little bit about how much appetite there is for some of these bigger names. Now, they are being replaced by other names, so at the moment it's not really a vendor problem. But I think people are becoming a little bit more picky at the bigger end, is my sense. Well, actually, we know because we back a number of them. So now that they've got 2 or 3 portfolios or 1 or 2 portfolios under their belt, they think, actually, we've done this big one. Now we'll just focus on not necessarily smaller, but more quieter and off-market situations. And as more banks are considering loan sales as an alternative to asset sale and other workout options, there are many more of these opportunities as there were a year ago.
I think one of the things is it's difficult to know what always the target return of some of these purchases are. Because people might make an assumption that based on the pricing, their target return may only be 12 or something, but it's not always immediately apparent what the objectives are and what part of that target return they're assuming will come from income. And there's also the sort of possible view that some of these guys have, significant overhead through servicing agencies and therefore need to create product to keep those guys properly occupied. But you can see a scenario where it goes back to the tail issue in a sense. You have your easy wins initially, and it's quite easy to achieve that through doing deals because you come in with a completely different base cost and no baggage with your borrower, but you're left with a rump. But you can see how there'll be pressure on those funds to get rid of that rump quickly on a portfolio basis to someone else who would then acquire that, probably in a slightly different cycle in the market, and deal with it in that way. Because I can't see them holding things on some of that stuff on a long-term basis based on their objectives.